Okay, so we have the second example here for this information. Now introduced return inwards or sales returns contra revenue account because it reduces your sales revenue. Return inwards is when a customer brings back goods to you. You sold them goods, they bring them back because probably they were damaged. Maybe they're the wrong ones. Okay. So return inwards lowers your sales revenue. And we have also introduced return outwards or purchases returns. This is when you return goods back to your supplier because probably they were destroyed, damaged, or the wrong goods. So the return outwards, it reduces your purchases expense because if you paid a certain amount for those goods and you've returned some of them, it means you need to be refunded back your money. So when you're refunded back your money, your purchases expense has to drop. So we're going to use the same format of the trading account, three columns here. As always, we start with sales return, sales revenue. Okay. So notice now, whenever there's return inwards, put the sales revenue in the middle. Okay. Because you have to make the adjustment for the return inwards. Okay. So after your sales revenue, you say less return inwards. Okay, return inwards 10,000. Mhm. It's on mute. No, it's not, madam. Are there others able to get me? Okay. Madam, try to log out and log in maybe. Okay. So sales revenue, we're deducting return inwards. Okay. So you're going to say 100,000 minus 10,000. That is 90,000. This is what you call your net sales. Okay. In other books, you see it written as turnover. All right. Yes. After you have done your adjustment to the sales, the next thing you need to tabulate is your cost of goods sold. Okay. Cost of goods sold or cost of sales. As always, you start with your opening inventory, the goods you started with at the beginning of the financial period or the year. Okay, so this company, when the year started, they had goods worth 35,000 kwacha. Okay. Next, they purchased goods worth 30,000. Purchased goods worth 30,000. Now notice I've put purchases in the first column because there's going to be an adjustment for purchases, which is the return outwards. Okay, so you're going to say less return outwards. Okay, we purchased goods for 30,000, then we returned goods worth 12,000 kwacha. Okay, so you're going to say 30,000 minus 12,000. Mhm. Okay. Wait, it's 18,000. 18,000, madam. 30 minus 12,000. Return. Oh, ish. Where did I put 12,000? Thank you for that. It's 1,500. Yes. Thank. Yes. So this value you get is net purchases. Okay. Your net purchases. Um, yes. Once we have our net purchases, we just add it to our opening inventory because we need to get the total cost of goods available for sale. So just remember this. After you have done your sales revenue adjustments, you know that, okay, next I have to get my cost of goods sold. So in order to get my cost of goods sold, I need number one, the total cost of goods available for sale. Okay. That is your opening inventory plus your net purchases. You're going to get 63,500. Okay. 63,500. Now we can tabulate our cost of goods sold. So we say cost of goods sold. Okay. Oh, we need to deduct closing inventory to get our cost of goods sold. So we're going to say less closing inventory. These are the goods we remained with at the end of the year. 12,000. Okay. So our cost of goods sold is our total cost of goods available for sale minus closing inventory. You get 51,500. Okay, this is our cost of goods sold. So our gross profit, our net sales minus our cost of goods sold, 38,500. Yes. Any questions so far?